Imagine this. You're standing in a $500,000 home. The kitchen is exactly what you wanted. The backyard is yours, and instead of wondering if you made a terrible mistake, you feel completely confident because you ran the actual numbers before you signed anything. That is the real difference between buying smart and buying scared. And right now, most people are buying scared or not buying at all because nobody is actually breaking down what it takes in plain English. That ends today. I'm going to walk you through the income, the down payment, the monthly costs, all of it, so you can make a real decision, not a guess one. In this video, I'm covering three things. The minimum income you actually need to afford a 500k home. What especially changed in 2026 that makes the difference from before, and the real down payment and monthly payment breakdown so you know exactly what you're walking into. Let's get into it. People are still using the same mental map to figure out if they can afford a home that worked back in 2020 and in 2021. And I get it. Those were the years your coworker bought a house, your cousin bought a house, your neighbor bought a house. So naturally, you're using the same logic they used. But here's the problem. Imagine you're driving somewhere new and you pull out a paper map or fire up one of those old GPS units that has not been updated in years. The roads look fine. The directions make sense. So you allow them. Except when you get there, half the roads have changed. There is construction, a bridge is closed, and you're sitting there wondering why the destination does not seem to exist anymore. That's exactly what's happening to buyers right now. The map they're using is years out of date. I have seen this play out firsthand. Someone close to me was running numbers in their head, feeling pretty good because they were comparing themselves to what buying looked like a few years back. The loan amount felt manageable. The down payment felt reachable. But when they actually talk to lenders and look at monthly payments in today's market, the numbers didn't match at all. Not even close. It wasn't because they did anything wrong. It was because nobody had ever given them an updated picture. That's what this video is for, because the landscape has genuinely shifted and a decision this big deserves the right map. So what actually changed in 2026? Let's talk about what actually shifted, because if you bought a home or knew someone who did between 2020 and 2021, what you saw during that window was a once in a generation anomaly. The average 30-year fixed mortgage rate dropped to historic lows during that period. We are talking 2.65% in January 2021, according to Freddie Mac's primary mortgage market survey. At that rate, a $400,000 loan costs roughly $1,630 per month in just principal and interest. That's it. And because rates were that low, a lot of people could stretch into homes they otherwise could not have touched. Fast forward to 2026, rates have stabilized in the 6.5 to 7% range after the Federal Reserve's aggressive hiking cycle that ran through 2022 and 2023. That same $400,000 loan now costs approximately $2,528 to $2,661 per month. That's nearly $1,000 more every single month than it costs at 2021 low. We are not talking about a small rounding error here. We are talking about a completely different financial commitment on the exact same loan amount. And here is what makes it even harder. Prices didn't come down to make up for it. The National Association of Realtors has reported that home prices in most US markets stayed elevated because of persistently low inventory. A big reason for that low inventory is something economists call that lock-in effect. Homeowners who locked in rates below 3% have very little financial reason to sell and give up that rate. So they are staying put. That means fewer homes on the market, which keeps prices high. So buyers today are dealing with higher prices and higher rates at the same time. That's the real story. That is why the old map does not work anymore. And I want to be straight with you here. This is genuinely harder than it was a few years ago. If you have been feeling like something is off, like the numbers don't just seem to work the way you expected, you're not imagining it. The math actually changed. But harder does not mean impossible. What it means is that you need better information than most people walking into this have. You need to know the actual numbers and not the ones based on the best case scenario that does not reflect your situation. The people who are buying successfully right now are not doing it because they got lucky. They are doing it because they did the math correctly before they ever started shopping. And that's exactly what we are doing in this video. Now you know why the landscape shifted. So what income do you actually need to make this work in 2026? That is the number everyone came here for. And that's exactly where we're going to next. The minimum income you actually need. Let's get to number you actually came here for, because this is a question everybody's either too afraid to ask or gets a vague non-answer on. So here it is, done transparently with real math. The most widely used affordability guideline in personal finance is called the 28/36 rule. The idea is simple. Your monthly housing costs should not exceed 28% of your gross monthly income. and your total debt load, housing plus everything else, should not exceed 36%. Lenders use variation of this, and it has been the standard benchmark for decades. So let's run the actual numbers for a $500,000 home. If you put 20% down, you're financing $400,000. At 6.75% on a 30-year fixed loan, your principal and interest payment comes to approximately $2,594 per month. Then you add property taxes, which average around $325 per month nationally according to Atom Data Solutions. The homeowners insurance, which runs about $150 to $167 per month according to the Insurance Information Institute. Add all of that together and your total monthly housing payment lands somewhere around $3,069 to $3,086 per month. Now apply the 28% rule. Take $3,086 and divide it by 0.28. That gives you approximately $11,021 per month in gross income needed, which works out to roughly $132 per year. That's your comfortable number. That's the income level where you're not stretched, not stressed, and not secretly hoping nothing goes wrong. Now, lenders will often approve buyers at debt to income ratios up to 43 or even 45% under conventional guidelines. So the minimum income to technically qualify for the loan may be lower than $132,000. But there's a real difference between the minimum income to get approved and the minimum income to not fill house for 6 months after you move in. The number that keeps you out of that trap is closer to that $120,000 to $132,000 range. And here is something that trips people up. That's household income, not just yours alone. So if you and a partner are both working, you're combining those numbers. That change the picture for a lot of people, and it worth factoring in before you decide what you stand. One more thing worth saying clearly. These numbers assume a 20% down payment, which is $100,000 upfront on a $500,000 home. Most people are not starting there, and when you change the down payment, the entire monthly picture shifts with it. So let's look at what this home actually costs you month to month across every realistic down payment scenario, because that's where the full picture starts to come together, the full monthly cost breakdown. Here is where most first-time buyers get blindsided. They have done the math on a mortgage payment, they feel good about the number, and then they move on and suddenly realize the mortgage was only one piece of what they are actually paying every month. So let's go line by line and build the real number together. Principal and interest on a $400,000 loan at 6.75% for 30 years come to approximately $2,594 per month. That's your base, but we are just getting started. Property taxes. The national average runs about $325 per month according to Atom Data Solutions. But this number can swing dramatically depending on where you live. In high-tax states like New Jersey or Illinois, property taxes on a $500,000 home can easily double or triple that average. So now your market before you assume the national number applies to you. Homeowners insurance. That runs approximately to $150 to $167 per month nationally, according to the Insurance Information Institute. This one does not move around as much, but it is still a real line item that a lot of people forget to include when they are running a preliminary numbers. Private mortgage insurance. This one only applies if your down payment is below 20%, and if it does apply, it typically runs 0.5% to 1.5% of the loan amount annually, according to the Urban Institute. On a $400,000 loan, that's anywhere from $167 to $500 per month added to your payment. It's not permanent in most cases, but it sticks around until you have built enough equity. And that can take years depending on your loan structure, maintenance, and repairs. The standard rule of thumb is 1% of the home's value per year. On a $500,000 home, that's $5,000 annually, or about $417 per month that you should be setting aside, not paying every month but saving, because when the water heater dries on the roof needs patching, that money needs to already exist somewhere. HOA fees, if applicable. The Community Associations Institute reports average fees of $200 to $300 per month. Not every home has an HOA, but if yours does, this is non-negotiable. It goes on the state. When you add all of this up, with 10% down in an average tax state, a conservative all-in monthly cost on $500,000 home can run $3,800 to $4,200 per month. And that's before a single utility bill hits your account. That's the real number, not the mortgage payment, the whole picture. Now you see what you're actually committing to every month. And the big part of what's driving the number is how much you put down upfront. So let's talk about your actual down payment options, because 20% is not the only path forward. The real down payment options. Let's talk about the number that stopped more people in the tracks than almost anything else in this process. 20% down on a $500,000 home is $100,000. And for most people, that number feels like a finish line that keeps moving further away every time they get close to it. So let's clear something up right now. 20% is not a requirement, it's one option among several. And depending on where you are financially, a different path might actually make more sense for you. Let's walk through each one. 20% down. That is $100,000 upfront. This gets you no PMI, the best available terms, and all in monthly payment in roughly $3,100 to $3,400 range. It's the gold standard for a reason, but it's not the only way through the door. 10% down. That's $50,000. PMI kicks in here, which typically adds $150 to $300 per month to your payment depending on your loan and credit profile. Your all-in monthly cost in this scenario runs approximately $3,500 to $3,800, more than the 20% pot, but significantly less cash required upfront. 5% down. That is $25,000. This is available on conventional loans for qualified buyers. PMI is higher rate at this level, and your all-in monthly payment climbs to roughly $3,700 to $4,000. The trade-off is getting into the home sooner with less cash out of pocket, while building equity over time. 3.5% down. That is $17,500. This puts you into FHA loan territory. To qualify, you will need a minimum credit score of 580 per FHA guidelines. The important thing to understand here is the mortgage insurance premium, and specifically when you put less than 10% down on FHA loan, that mortgage insurance stays for the life of the loan in most cases. It does not fall off automatically the way PMI can on a conventional loan. There's a long-term cost that's worth weighing carefully before you go this route. And then there's something that a huge number of buyers completely overlook. Down payment assistance program. These are generally underutilized. The down payment resources database tracks over 2,000 assistance programs across the country for eligible buyers. These programs vary by state, income level, and loan type, but they exist in far greater numbers than most people realize. If you have not looked into what's available in your area, that is worth doing before you assume you have to come up with every dollar on your own. The point is this: the down payment conversation is more flexible than most people think. You're a real pass into a $500,000 home at multiple cash levels, but the down payment is only part of upfront money you need. And what comes next is what tends to blindside buyers right at finish line. So let's talk about that. The hidden costs that catch buyers off guard. This is the part most content skips over. You have got your down payment saved, you know your monthly number, you feel ready, and then you get to the closing table and realize there's a whole other layer of this cash you needed to have ready. This is where otherwise prepared buyers get caught completely off guard. So let's go through every number you actually need to have accounted for before you make a move. Closing costs. According to CoreLogic and Freddie Mac data, closing costs typically run to 2 to 5% of the loan amount. On a $400,000 loan, that is $8,000 to $20,000 due at closing, on top of your down payment. Not instead of it, on top of it. A lot of buyers know closing costs exist in theory but do not have a real dollar figure in their head until they're staring at the settlement statement. Now you do. Cash reserves. Many lenders require you to have 2 to 6 months of mortgage payments sitting in your account after closing, not spent, still there, untouched. On a $3,200 per month payment, that is $6,400 to $19,200 that needed to remain in your account even after you handed over everything else. This trips up a lot of buyers who drain their savings to cover the down payment and closing costs, not realizing the lender was going to look at what was left. Moving costs. The American Moving and Storage Association reports that average local moves run about $1,250 and long-distance moves average around $4,890. Realistically, you should be budgeting somewhere between $2,000 and $5,000 depending on how far you're going and how much you're bringing with you. First year surprise expenses. A home inspection is a great tool, but it catches non-issues. Not everything. Homes have a way of introducing themselves with unexpected problem in that first year. A dedicated home emergency fund of $5,000 to $10,000, separate from your regular emergency fund, is a best practice that most people only adopt after they have already been burned once. Get ahead of it. Now let's put the upfront picture together with 10% down. Your down payment is $50,000. Closing costs at roughly 3% add another $15,000. 3 months of reserves adds $9,600. Moving costs run about $3,000. And the first year emergency buffer brings another $5,000. Total recommended cash usage approximately $82,000 and $600. That's your real saving target, not a vague. Save as much as you can. An actual number with actual line item behind it. Now you know exactly what you need to walk into this ready. But here's something that surprised a lot of buyers. You can have all of these and still deny it. Because lenders aren't just looking at your income and your savings. Let's talk about what they actually evaluate. What lenders actually look at beyond income. This is the part that catches people off guard. Even when they've done everything else right. You can have the income. You can have the savings. You can have the full cash position we just talked about. And you can still get denied or get approved at terms that cost you hundreds of dollars more every single month. So let's talk about what lenders are actually evaluating beyond your paycheck and your bank balance. Credit score. For a conventional loan, the minimum is 620 per Fannie Mae guidelines. But the minimum to qualify and the minimum to get a good rate are two very different things. Buyers with scores above 640 to 670 typically access the best available rates. And that difference compared to a 680 score can translate to $100 to $200 more per month on a $400,000 loan. Over 30 years, that's real money. According to Experience Consumer Credit Review, the average US FICO score is 715, which is in range but not optimal. A focused 6 to 12 months credit improvement plan before you apply can meaningfully change the rate offer you walk away with. Debt to income ratio. Lenders look at this in two ways. Your front end DTI is just your housing cost divided by your gross income. Your back end DTI is all of your monthly debt obligations combined housing, car payments, student loans, credit cards, everything divided by 4 gross income. Conventional guidelines typically cap back end DTI at 43 to 45% per Fannie Mae and Freddie Mac. Here is where it gets important. If you're earning $10,000 per month but you're already carrying $1,500 in existing debt payments, your effective qualifying power is significantly compressed. Even if your income looks strong on paper, the debt load is quietly eating into what you can actually borrow. Employment history. Lenders typically want to see 2 years of stable employment in the same field. If you're self-employed, the bar is higher. 2 years of tax returns, profit and loss statements, and often additional cash reserves on top of what W-2 employee would need. Bank statement review. Lenders go through 2 or 3 months of your statements. Large unexplained deposits can raise flags during underwriting. If a family member is gifting you part of your down payment, there is a specific gift letter process that has to be followed. You can't just have money show up in your account without documentation. Here's the truth that lies all of this together. You can earn $150,000 a year, have $80,000 saved, and still get denied or get offered significantly worse terms because of an unoptimized credit score, a quietly high DTI, or an unexplained bank deposit. Understanding the full picture before you start shopping is not optional. It's essential. Now you have the complete picture. Income, monthly costs, upfront cash, hidden expenses, and lender criteria. The only question left is what do you do with all of this? And that depends entirely on where you're starting from right now. What to do right now based on where you are. Everything we have covered so far is only useful if you know what to do with it. So let's make this personal. Because where you go from here depends entirely on where you're starting from. And there are really 3 types of people watching this right now. So find yourself in one of these camps and take the action that actually applies to you. Camp 1. You're at or above the income threshold and you have the savings. If that's you, the move is simple. Stop researching and start moving. Get pre-approvals from at least 2 or 3 lenders and compare the rate offers you get back. According to Freddie Mac research, borrowers who get multiple mortgage quotes save an average of $1,500 over the life of their loan. And those who get 5 quotes save an average of $3,000. That's money sitting on the table just for making a few extra phone calls. Then here's the mindset shift that matters most. Work backward from your comfortable monthly payment, not the maximum loan amount you qualify for. Qualifying for a loan and being financially healthy with that loan are 2 completely different things. Knowing the difference before you start shopping. You're below the threshold, but you're within striking distance. You're not out of this, and there are specific levers you can pull. Aggressive debt paydown improves your DTI, which directly expands what you can qualify for. Income growth, whether that's a raise, a career move, or additional income from a side hustle, moves your qualifying number in the right direction. And strategic down payments building reduces your monthly obligation once you do buy. Also pay attention to rates. A 0.5% rate drop on a $400,000 loan reduces your monthly payment by approximately $120 to $130. That is $1,440 to $1,560 per year back in your pocket. So rate alerts and be ready to move when the window opens for you. Camp 3. You're significantly below the threshold right now. And I want to say this clearly. This is not a you can do this moment. This is a let's build the right foundation moment. A $500,000 home might be 3 to 5 years out for you. And that's not a failure. This is a plan. Three things to focus on right now. First, use the full upfront cost number from earlier in these videos as your real savings target. Not a vague goal, a specific number. Second, build a debt payoff strategy that improves your DTI before you ever apply. Third, map out an income growth roadmap with specific milestones so you're not just hoping things improve, you're engineering it. Here's the beautiful part about everything you just walked through. Most people never run these numbers. They either convince themselves they can afford something they can't, or they talk themselves out of something they actually could do. You just did something different. You looked at the real math, and whether your answer today is I'm ready, I'm close, or I've got a plan, all three of these are wins. Because clarity is always better than confusion when $500,000 is on the line. Now, here's the thing, you can know all of this, have the income, have the plan, and still find yourself wondering why the savings account never grows. And a lot of the time, it comes down to one trap that's way more common than people want to admit. I made a whole video about it. It's called the Pavement Princess Trap, and it might be the most important thing you watch after this. Go check it right now. I will see you there.